Okay. So, welcome everybody to our first virtual meetup event, Python for Finance, brought to you by the Python Quants, AI machine, and I'm incredibly proud to be sponsoring this event on behalf of the Refinitiv developer community. Okay, next slide. So we have a really interesting agenda for you today. We've got some fantastic speakers. We've got Dr. Richard Peterson and Anthony Luciani from MarketPsych LLC, who'll be talking about creating market forecasts with news and social media data. And then we're going to have the theory about that. And then Anthony's going to take us through some Jupyter Notebooks showing the practical side of how to implement this, these techniques. Then Yves is going to talk about reinforcement learning from playing games to trading stocks. So that's going to be a super interesting presentation. And then just at the end, we'll have a book raffle and then some closing comments. So on your the screen in front of you, you should have a question and answer panel as well as a chat panel. So if you need to, if you'd like to ask any questions, please feel free to just type in questions as and when they kind of come up in your head, and then basically at the after each talk, we'll be able to have some Q&A time with the speakers. We'll try and get as many of those answered as we can. And then at the end, we may have some extra time as well in case we can't deal with them all. So, okay, Yves, I think let's move on a little. So what we've done, we've amalgamated some of our meetup groups. Obviously, the meetup platform itself only allows for in-person live meetups, but obviously with the current situation, they've allowed us to host events virtually now. So this is actually really fantastic for us and also for you, because we can reach so many more of you. So actually today we've amalgamated our meetup groups from London, from New York, Berlin, Frankfurt, Paris, Saarland, Luxembourg. So if we have a look at some of the details of these groups, we can see that this meetup is, you know, the Python group in London, for example, has over 3,000 members. So we started that in 2014, and it's now one of the largest groups of its type really in the world, certainly in Europe. And then we also took the opportunity last year to expand into New York with AI in finance and algo trading meetup groups there. So we have a one event there, but now of course we can, now we are virtual, we can have many more frequent meetups to cater to the demand that we see is there. In Berlin, we have over 500 members from Yves' group there that he'd been running for a few years there. And I think, so welcome to all of you who have made it today. And I think also in Paris is there, Frankfurt, here we have 200 members in Yves' group there, AI, algorithmic trading and AI first finance. So welcome to you all from there. And then Paris as well, so we have 300 members. I think that's Yves' group there as well, where he's had one event. So hopefully we can reach more of you there. And I think, and of course, the 150 plus members from Saarland, where Yves is based, very close to Luxembourg as well. So we welcome many of you from there as well. Now, in addition to that, I've noticed on the registration form that we do have attendees from as far as South Africa, Brazil, Russia, Singapore, India, Peru, Colombia. So I'd like to really welcome you all to this event. Hong Kong, even Australia, somebody's staying up late or early in the morning maybe, United Arab Emirates. So it's a really international crew here. So, I mean, if you want to chat to each other, Please make use of the chat facilities, and if you want to ask any questions, as I said, just put it in the Q&A panel. Okay, so with that, I will stop talking and hand over to Dr. Richard Peterson and Anthony Luciani from MarketPsych LLC.
Great, thank you, Jason. So I will change presenter to myself. Is that the protocol here?
I will do it. I will do it. So give me.
Oh, you'll do it? Okay,
1
great.
second. So we should
see it.
We should be all set.
Yep.
Excellent.
Perfect. Great. So hopefully my topic will be useful in these interesting times. We know in financial markets these days that prices are often driven by what's in the media. What's the latest news on vaccines or treatments? What is the latest social media concern? And so what I'll show today is the influence of media, like news and social media, on market prices, and more specifically, the data that we produce around news flow and information flow, and then how that information flow and that data can be analyzed quantitatively to produce predictive signals. And in particular, I'll show 3 types of signals that we've found in this data. So before I really jump into what the data is and how it's constructed, I'll show this slide, which is an image of Apple since 2018, September 2018. The share price is the yellow bars. The two other moving averages are moving averages of media sentiment, both news and social media, about Apple. It's a 30-day average versus a 90-day average of media sentiment. So sentiment is the net positivity versus the net negativity in the tone that's used to describe Apple in the media. So when the 30-day average goes under the 90-day, we put red shading between the 2 lines to show that the media is more negative recently about Apple. And then when it becomes more positive, we show green shading there. And this is intended to demonstrate that at times, media seems to precede the price, especially around downturns. So that's one thing we see in this chart. I put some red arrows here. There are, however, misfires. As you can see, sometimes sentiment is reacting to the price movement rather than preceding the price movement, which you see in the middle arrow. And then most recently is the arrow around COVID. And you can see that actually sentiment dropped quite dramatically before the share price dropped. So investors were quite worried online and in the news media before Apple came out with their profit warnings related to the COVID shutdowns in Wuhan. So this is just a simple demonstration and overview of what this type of data looks like, how information flow may be useful in understanding markets. But before I jump into that, I'll give you a bit more background. The big picture is that in financial markets for many years, we've had pricing data, of course, and economic data like earnings and economic growth. But data sets like that are often delayed and slow, and they are about what already happened in the past. If we want to predict future behavior in markets, we've got to understand what are the people who are trading in markets thinking about? What information are they processing? Because as we know, information moves market prices. New information changes how we value goods. And if we can gather that information and then work with it as a data feed, perhaps we could get better forecasts of the future. And it's not just me saying this, of course. We have insights from behavioral economics showing that individuals are non-rational when they deal with prices. There are a lot of weaknesses to that research, though, especially when applied to markets. So then we often turn to academics who are working with anomalies in markets, and they describe patterns like overreaction and underreaction in market prices. But that's not necessarily enough either. We do have market practitioners who don't use words, fancy words like overreaction or underreaction. They talk about greed and fear, or bearishness and bullishness. So perhaps we can learn from them as well. And what we've done, and what I'll talk about now, is how we create this type of data set where we can measure bullishness or bearishness, or greed and fear, and then look for patterns by using statistical techniques that, of course, in Python, allow us to extract predictive signals from this type of data set. And our own background is in behavioral economics. So we've written some books on behavioral economics, and then most recently in 2016, this book, Trading on Sentiment, which is about market patterns based on price action, or based on information flow data. So we do a bit of a review of the academic literature, and then largely the book is about our own data set and how it seems to apply to market patterns. And we do have this now in Japanese and Chinese as well. We've been partnered with Refinitiv since 2011, exclusively to do the sales and distribution, which allows our company MarketPsych to focus on the data set itself and producing really interesting data. So I'll start with a bit about the media monitoring and what it is that we do. And I'll start in a very primitive way by just showing how we started in 2004, which was counting words. So this is called the bag of words technique in NLP. And what we did was count words like fears or panic, especially those associated with a noun like stock market or stocks. And this is the very basic beginning technique that some people do, although now, of course, we have better techniques to get started with. But this is something we did because we wanted to track emotions. And it was very difficult to use machine learning to have an accurate representation of emotions represented in text because there simply aren't that many, especially in the financial text. So if you can imagine counting words like these in these headlines, and then we move towards some very primitive breakdown. So if we were to take a headline like US stocks tumble again as fears of coronavirus grip markets, and we count the number of times fear appears in that sentence, which is once, or the number of times that, or the amount of negativity embodied in that sentence, which is essentially, a weighting of 1 on negativity. It's a very negative sentence. Or we look at things like themes, like maybe human diseases. We see in this sentence, South Koreans diagnosed with viral pneumonia, that we have a reference to human diseases, a human infectious disease in South Korea. And this allows us to create not only counting words as a basis, allows us to create indexes. Now, of course, then we have to evolve. We have to use part of speech recognition and understand subject-object relationships. And we have to understand who is afraid, or what are they afraid of, and are they a little bit afraid or very afraid? So we have to understand many different nuances to language, which ends up becoming much more complicated. But the basic idea is this. And by adding up those phrases and those concepts, we're able to create interesting time series indexes over time to see when there is a lot of fear in the market, is it true that we should be buying? So if there's a lot of fear in the media, does that in fact give us a buy signal? Most of what I'll be talking about today in this presentation, and Anthony, who will join me, is sentiment, which again is the net positive versus the net negative conversations in the media about a given asset. So it's an overall balance of positivity or negativity. But we also track many other things, many other emotions, tones like surprise or uncertainty. And also you can see for different asset classes, we track very unique themes. Now we derived the psychological indexes that we track by looking at the marketing literature. We wanted to understand what is it that marketers have identified in language that causes people to buy or to sell? Because in the retail industry, they study that. And we figured maybe we could apply some of these to finance. And then we looked vertically in the SSRN literature, on the economic papers that have been written. What are some sources of data that have been identified as being predictive in those markets? And maybe we could pull this out of the text as well. So we created these indexes for each different asset class. So for example, in different countries, we know that agricultural stress affects economic output, or budget deficits, or consumer sentiment. All of these are hypothesized or known to be drivers of economic activity. So we decided to figure out how to quantify these in text, and that's what we've done. Now, in the current environment, we are, of course, tracking fear, and this, unfortunately, this box is misaligned, but it should be on human infectious diseases. Now, the way we pull these out is we're actually looking at about 2 million business-related articles every day, and we pull out those from 2,000 news sources, the top 2,000 global news feeds that we've licensed globally, and 800 financial social media sites. We do multi-language translation as well, so we have Arabic, Portuguese, Chinese, and Japanese sources in here. And so we're really trying to get a global picture of what's happening in the major economic regions. We create media sentiment, so streaming media sentiment for every major country in the world, 15,000 global companies, stock indexes, bonds, currencies, commodities like crude oil, of course, which you'll see an example of later. And we do have history back to 1998, so about 22 years now of data to analyze, including social media all the way back to 98, from stock message boards and forums, for example. Now, the data is in minutely, hourly, and daily feeds, and we do have customers now in 25 countries who include pension funds and low latency traders as well. So our minutely feed seems to be fairly useful for some of the low latency traders. So here's how the data looks. So just to get a sense of what it is I'm talking about, because once we have a sense of what this data is, then we can, of course, look at how it might be useful in predictions. So this is a sample of our country's data set, and it's a 24-hour average in this case. So this is data from Australia, China, Eurozone, Russia, Saudi Arabia, Turkey, and the US. You can see on the left here under asset. And the first table is news, the second table is social media. Now, if we look at a given day, say Australia along the top row, 88,000 in the buzz. That means that there's about 88,000 relevant references to cities, provinces, or Australia itself in the global media. And of that, about -9% fear. So there's a balance of negative sentiment about Australia on this particular day. Now, if we go down to that red box, we see that, in fact, the sentiment about Saudi Arabia and Turkey was very negative relative to the other countries. And this is because of the Khashoggi assassination, which happened around this time. Now, if we look over at the violent crime index, we also see a very high violent crime index for those countries relative to other countries, meaning that there's a lot more violent crime being reported, of course, in this case, an assassination. Now, you've noticed, I'm sure, that this is aggregated data. We're not getting every article out, so you can't sort it by author or source, but rather by equally weighting and aggregating this data. We're trying to help you find universal predictive patterns and how information flow affects markets in every major asset. And in doing that, we believe that this is a more efficient way to start studying this data rather than looking at every article or every source, because sources change. And we also see that the herd of viewers changes from source to source. Some have more credibility at some times, other times others do. And now, for example, with violent crime, when we see a high index in something like violent crime, you can imagine that maybe portfolio managers who read about something negative about crime rates, whether it's a crime wave or riots or assassinations, when they see that in the news, they're more likely to maybe pull out of that market, or if they were in the market, maybe not to buy additional shares, or if they're thinking of getting in, to delay any purchasing. So that in itself creates some downward pressure. And sure enough, both Saudi Arabia and Turkey had sell-offs in their stock markets after this assassination. Now, that also happens when there's crime waves, violent protests, or crackdowns on protests. So kinds of violence in a given country will affect their stock market and their currency. Now, there's only one major assassination that I can think of in the last few years, which was the Khashoggi one. So, in a developed type market. So it's difficult to test one by one, but if we aggregate them together into themes, it allows us to have more statistical confidence that what we're finding is a true effect on human behavior, especially human buying and selling behavior. So that's the goal of this data. And you can see it visually like this. This is a economic growth index that we pulled out of the media during April until yesterday. And so you can see that where economic growth is said to be strong, in fact, this month it's said to be returning in China, and that's why we have positive growth again in China, yet negative in Japan, the US, Mexico. So several of the countries, of course, that are hard hit by the virus, France here, Ireland, Norway because of oil prices, probably Finland. Some of these countries are showing some slowdown. Other countries don't seem to show it as heavily, according to the media. Brazil, of course, quite a negative one there. So we do have these visualization tools, which Anthony will show you later, to allow you to essentially validate that this data is actually picking up on what it says purports to do. We find that our clients really, of course, need to see data visually to truly understand it. So I will turn this over now to Anthony. Anthony, would you like to use my screen or use your own screen? Probably your own, right?
Sure, yes, I'd like to use mine, thank you. Could you transfer?
I'll try to do that.
I'm going to make you presenter, right?
All right, thank you. Well, hi everyone, my name's Anthony Luciani. I'm a researcher at MarketPsych, and over the past year or so, I've been helping construct some internal equity models and currency models and trying to forecast inflation and interest rates as well. So I'm just going to cut back to this presentation here. Can everyone see that?
Thinking, no.
I'm hoping so.
Share your screen. Now it's coming. That's good.
Okay, great. So yeah, so I'm going to cover some traditional research associated with this data, but let's just first go back a few slides and recap exactly what the data set is. This is aggregated data from the top 2,000 social news websites and 800 social media websites, aggregated into these time series, which are available at daily, hourly and minutely feeds, and this data is released to or sold to governments, funds, slow and fast, and as well as the SEC and as well as universities. And in fact, I'm just going to cover some of the university research that we've looked at or has been performed on this data over the past 11 years since the data has been released through Refinitiv. So some of these academic articles have been released in rather top-tier journals, such as you have Journal of Portfolio Management, Quantitative Finance, and AI and Society. And in fact, the book Trading on Sentiment is also a handbook for this data, because it uses behavioral biases existing in psychological literature and exploring how they can be essentially exploited or used in financial markets and in financial contexts. So some of this research, for instance, one by Stan Beckers, compares our social media and news streams, which is actually our data is released into two separate streams and then one combined one. He compares those two isolated streams of sentiment data for their predictability in equity markets. And his assessment found that not only do features from each stream have different impact sizes on returns, but also the sign associated with those trained coefficients representing the polarity of that relationship reverses over different time periods. So you can see here, emotional news over 1998 to 2002 seems to be more impactful than emotional social media. Now that might actually be because there really wasn't as much social media in the around that era even, but nonetheless, perhaps emotional news or news in general is what people were paying attention to more at that time. And then we have some research here on the right by Svetlana Borovkova. She's also a user of the tRNA, the Thomson Reuters News Analytics dataset, which is also released through Refinitiv, and that's an article by article feed. What she did here was construct in 2018, she employed a few more complex tools, such as Kalman filters for smoothing, multi-layer perceptrons for isolating important features, and LSTMs for time series prediction, all in an attempt to predict the intraday movements of the Eurostoxx 50 index, with some very promising results, actually. She had something like 75% correct daily downwards direction signals. You can find the paper itself. It's available on SSRN. You can search that, or we'll be able to provide a link afterwards. As you can see, this histogram of correct versus incorrect results here up in the top right, showing you that the distribution of the correct results is quite larger compared to the incorrect results. Obviously, there's many paradigms of machine learning and backtesting that need to be performed on this data, but we'll just start off with some basic examples of how this data can be used. So this is, again, a nice heat map that we created from our Icon app, which I'll switch to now, which is actually available for you to head to as well. You can do this yourself. You can head to iconapp.market.com. That's icon with an EIK rather than IC. So, and really you can tell that from this data, there's a lot available. We'll get through it. But I'm just showing you here that, for instance, Russia here has a low ranking on its, or a low value on its economic growth index, which can be plotted on this graph, and vice versa. You could change something to say, only look at economic growth from social sources, and the graph can be produced, and you can set your dates and start date and end date over which the average of this time series for the for all countries in this case is made. So you can see here, actually, it's slightly weaker when you don't look at Western news. So this, in fact, the negative polarity of Russia is slightly weaker when you don't look at Western news and you just filter by social media. Well, either way. So this Icon app, I'm hoping you're going to use it at some point, allows you to discover our sentiment data and plot visualizations for multiple different asset classes. So as you can see here, I'm just going to choose equities. We also have the links to our research papers and the documentation about this data as well here. So the data covers 15,000 US equities, many stock indexes. Most tradable and liquid assets are available. So we have recent news available. We have some simple pie chart visualizations, which describe the most talked about stocks over the past, say, 7 days. So in this case, it's Facebook and Amazon, and of course, the natural rate of which people are talking about the stocks might not change so much. But when you look at the changes in attention for a stock, especially for low market capitalization stocks, you can actually find a lot of value there. And as a low market cap stock grows in attention by investors, naturally so does, in fact, its price in its early days. And in fact, if we instead just look over the past 30 days by the average of our sentiment index for US equities, we can see that the most positively perceived stocks over this period are here. We have Alloc Industries. In fact, it's better if we head to a nice heat map, which shows exactly what. So in this case, what we're taking a look at here is since 2019, we're going to plot the size of assets represents their attention, and the color of assets represents the sentiment of all references to that asset. So you can see the most talked about stock since 2019 actually is Tesla, followed by Facebook, and we have smaller ones such as BuzzFeed. It's not the smallest, of course, but you can see that the most positively perceived stocks are Xiaomi and PG&E, and these references to stocks aren't just pretty visualizations. We do actually have data that supports the idea that most talked about, the most positively perceived stocks outperform those most negatively perceived. And I'm going to head back to our presentation here just to show you what I'm talking about. Please. So actually, what we're talking about here is a concept called underreaction from the psychological literature. In fact, you could change it for trend and mean reversion in technical analysis if you wanted to. It's the same concept in that people underreact to news. And in fact, Jose de la Vega, who wrote one of the first financial texts on financial markets, wrote that as there are so many people who cannot wait for the follow the prevailing trend of opinion, he's not surprised that a small group becomes an army. And what he's saying essentially here is that people follow the prevailing opinion, and in order to follow, that's a past. You're acting on something in the past. So it's really you're trending on what someone else has done before you. So in fact, this research here encompasses this actually. So what we see here is a bit of research I performed on our US equities data. And what I did here was over the period of 2006 to 2018, I ranked all US stocks every month by their past 30-day sentiment, and then averaged the sentiment over the past 30 days, and then ranked these stocks into the highest and lowest, and then grouped them into deciles of equally sized 10%. And then I just shaded the deciles and then observed the price change for the subsequent 90, 100, 180 days into the future after these stocks have been grouped by decile. And we can actually see here that the most positively perceived stocks in green outperform those most negatively perceived by the media from their media over the course of -30 to 0 on this graph. And they outperformed them for the next 90 days in this graph. As you can see, the spread between the most positive and the most negatively perceived stocks increases. And in fact, it increases up to 180 days into the future. So this is a really interesting concept here, is that using only a 30-day window for sentiment data, we're able to somewhat predict the spread between global stocks into the future up to 180 days here. And in fact, if you extend the observation window to from 0 to -90, you can actually expect the spread to increase beyond the 180-day window up to 270 days, which is what we found in some other research. And this research is actually, we replicated it on various windows across other stock markets. For instance, these are all European stocks. So what we did here was we averaged the past 360 days of sentiment and ranked stocks into quartiles, and then observed the price drift, the average drift in price of those stocks for the subsequent 350 days. And naturally, if you're sampling this every month, then you're going to get a lot of overlapping price data. But this is just for research. This is just for visualization purposes to show that there's some spread. If you would actually include this overlapped data in your models, you would have some problems with overfitting to relationships you've created out of thin air. So this is a very good visual of showing that the research, the positively perceived stocks outperform those most negatively perceived. Our most simple concept that something positively perceived outperforms something negatively perceived is still expected in markets. But in fact, actually, I'm just going to go back to this first one. When I first performed this research, I mean, this is an aggregation across the whole of 2006 to 2018. What I found was that this relationship between this positive, this linear, this monotonic relationship between the sentiment and the returns, as you can see through the coloring, as the shading of the colors is quite, is useful here because it means you can rank stocks and their sentiment actually predicts where they will be in terms of the basket of goods coming out of it. When there are economic drawdowns, this relationship can actually invert, and the most negatively perceived stocks start to outperform those most positively perceived. Largely, I believe, because after the drawdown, those most negatively perceived stocks drew down a lot, but it was an overreaction to the news surrounding them. So it's really interesting to see that there's this reversion, and it's happened for 2008, I believe, 2012 and 2015 as well. It's very interesting to see. Nonetheless, it's important that you have some kind of some updating parameters in your models anyway. So okay, this is a bit laggy, but it's okay. So we have this another use case of this data, and what our subscribers of this data have found is that it's very useful as a risk-off. In fact, just as I mentioned about drawdowns, we have a partner, or a subscriber, and then investment partners who have roughly 270 billion assets under management, had used our sentiment data in the past to deleverage before 3 of the 4 most recent equity market drawdowns, not including COVID. And what they look for are the emotional triggers, such as high stress and high panic and uncertainty in markets. And we actually have for instance, an index called emotion versus fact, which pits emotional content of sentences and emotionally charged words against factual statements about a company, and when you create that relationship and you see it fluctuate between what essentially we could call rationality and irrationality and more personal involvement about the way a stock is valued, you can tell that people are becoming more irrational. So, and that's what we see is largely one of the large drawdown predictors in financial markets. So I believe we can actually cut here to our yep. So actually here what we can see is the US-China trade war. All we can see currently is the Chinese yuan USD currency with high values implying that the Chinese yuan is strong and against the dollar. And what we're actually showing here is the period from which Trump has been inaugurated. So Trump was inaugurated in 2017 and so forth. So I'm going to go ahead and include the sentiment data here now. So what you can see here are 2 moving averages, one 30 days, one 90 days. So the slower moving average is moving faster than at the same speed, faster than the longer moving average. But essentially, when the short-term sentiment is above the long-term sentiment, we use this green shading, and vice versa, this red shading for when the short-term sentiment is below the long-term sentiment, the perceptions about, in this case, the yuan versus the currency pair. So for the period of 2017, Trump has already expressed his discontent about trade with China. In fact, he's done it well before his inauguration as well. But over the course of 2017, the US let's see, yeah, the US trade deficit with China reaches $375 billion, which is a deficit which has continued to grow over the past 25 years. But it was only into the second year of Trump's presidency, 2018, around March, that he began to impose some safeguard tariffs on Chinese goods. And we know that Trump is pretty crazy with his tweets. If you've been looking, I believe JP Morgan or someone released even an index or something that evaluated Trump's individual tweets in terms of how much it will impact volatility in markets because they are that impactful. And what we can see is around April 2018 even, he imposed these safeguard tariffs, and this was quickly met with retaliation from Jinping and the Chinese government, which escalated into the trade war we see today. And obviously, well, actually, it's been across 2019, and right now it's kind of unraveling. But what we see here is that this short-term media sentiment, colored in red, is a leading signal here, and this drawdown in sentiment precedes this drawdown in the Chinese yuan value. And in fact, around 2018 October, at this point, the US stock market has declined around 10%, and midterm elections in here. So Trump says there's good progress on talks with China, sentiment rises, and finally, when the S&P is at an all-time high around here, Trump again says that tariffs will rise and the cycle continues. And what we're really establishing here is that, hey, look, there's an underreaction here. There's this positively perceived yuan across the whole of 2018, and then as soon as Trump tweets, the whole sentiment around the strength of the currency pair collapses, and again he manages to create this fluctuation, which I'm sure some people are using very successfully to trade the pairs. So there are several actual key features to note, most notably around this April, this is aggregated sentiment, again, from the top 2,000 news sources around the world, and it's dropped significantly as this trade war took place. And in fact, it dropped well before the value of the yuan dropped, as you can see. So this leading indicator would have prevented someone that's holding the yuan from experiencing that drawdown. So at MarketPsych, following the behavioral economics literature, we classify these as under and overreaction. And now a common question here is whether such a signal is leading or whether it's lagging. I mean, these are moving averages, so you'd actually want to use something like a Kalman filter to produce a faster signal. But it's entirely possible that the dominant media topic of the day is a reaction in response to a recent market movement, which in that case, you would expect to see sentiment following the price of the entity. But in fact, one of the ways we prevent this at the text ingestion level at MarketPsych is we just use future-looking references to entities. So only considering future tense verbs, or future tense statements, we can consider only subsets of opinions and facts that are forward-looking. But another interesting way we found to isolate what we refer to as reactionary and then novel components of sentiment is to use the price data of the underlying entity itself. And we found that in doing so, the desirable statistics, such as the high Spearman correlation, are obtained. So I believe I'm just going to showcase some other interesting moving average graphs now. So I believe one very interesting one we have is crude oil. And it's a very long period here from January 2004 all the way to the start of this year. But what we can actually see are key points when the crossover here and the short-term, essentially the excess short-term sentiment is negative. We can see that this happens very often during large oil drawdowns. So this is the price of crude oil, WTI crude in orange. And the same concept here, we have a 90-day moving average of our crude oil sentiment from news. and a 200-day moving average as well. So you can see these large fluctuations in the sentiment.
Anthony, you could show it recent period as well.
Oh yeah, is that true? Okay, I will.
Year-end
just,
date is 2019.
Right. I'll just include the rest of the years. So actually, I don't know what the results are looking like yet. So I'm gonna skip back to what I did want to show, and we'll see if it still happens across 2019, 2020. So what you can see here is that as the short-term media becomes discontent with the price, there are drawdowns in the price of crude oil. This largest one here being around May 2014, and you can see across the periods that there are these essentially fluctuations and pumping of media sentiment around the price of oil, which drives it down. So yeah, I think we can skip back. So actually, this research was published in our Trading on Sentiment book back in 2016, and it's still continued to perform the same across up to today even. So we can see here that there's another large drawdown here. And I believe, okay, just here, well, I mean, oil's been having some pretty crazy properties recently, but anyhow, we can use this data to predict drawdowns. And in fact, we can use it in multiple ways. So I believe now I can move ahead to some of our Jupyter Lab notebooks. So these are available on our sandbox. I think the sandbox is currently locked, but these will be available and you can use them yourself. I'm sure everyone's a Python user here, of course. So now we can actually dive into some interesting MACDs. Wonderful. MACDs around this data. So what we have here are again, the moving averages. And all we do is, I believe in these examples. Wow.
Sorry, Anthony, can you just click up this the font size slightly? It's quite hard to see.
Sure, I'm just hoping the internet turns back on. Having some technical difficulties here. All right, so I'm sure it will come back, not to worry. But we can still talk about other relationships in markets along with sentiment. So I definitely encourage you to explore the Icon app. There's a lot available for you. But what we've done here actually regarding those moving averages is use two moving averages to construct a trading strategy out of the sentiment. So here we can see a large drawdown. So this is the oil price again. And we have here a 90-day moving average and a 500-day moving average. And what we've done here is when the short-term sentiment is positive, we go long. And no, it's just a long-only strategy. So all we do is hold when the short-term excess positive sentiment is there. And what we can see actually is this in this red period, these red shadings here are corresponding with these red movements here. So we exit the market.
It's a long short.
Okay, sorry, it's long short. And this was actually done by our other quant, Tiago Teodoro. So it's a very comprehensive graph of a trading strategy built on this data. So starting in 2006, if you were to hold $1 worth of US oil, you could expect it to be up 9.7 times since that period. And we're excluding the most recent period because it's exceptional. So yeah. And in fact, what I did want to show you is these MarketPsych notebooks, Jupyter notebooks that you can use to construct these strategies on the underlying data. So we're back. And what I have here are some typical imports. Let me see if I can now increase this. Okay, I can. Okay, here we go. I hope this is clearer now. So again, what we're doing is taking a look at moving averages and constructing strategies out of them. Now, what you've seen so far and what you'll continue to see are just visually compelling images of moving averages. If we're not picking or optimizing the window sizes, we're really just using things that are visually appealing, 30 against 90 or 200, and functionally they're appearing to be useful. So what we've done here is construct some functions to plot some MAC, so plot those moving average graphs with a short and a long-term moving average. And I won't go into the details of this because essentially it's just a plotting of graphs and just aggregation of data. It's a very simple strategy, and we wouldn't expect to actually use this in practice in isolation. We would combine it with some other data as well, some perhaps non-sentiment related factors, past price data, anything else we think is relevant for the underlying signal. So let me go ahead. We retrieve the history of the asset, which is the data, through our API, and we go ahead and download the daily prices of this asset. In this case, we have it located on our servers, but you can use your Yahoo or the API associated with it. So what we do here is we just plot the graphs, plot the MACDs against plot the moving averages against the graph. So yeah, what I'll go ahead and do is run all of this. So here what we're doing is we are employing a long-only strategy, which means we only hold crude oil, when the 30-day moving average is above the 90-day moving average. So that's what the moving averages look like. And actually, this is what the strategy looks like. Now, obviously, it appears as though it's underperforming here, but it's a lot less volatile than the crude oil itself, which is good for some. So, and in fact, when we do isolate only, for instance, 2014 to 2019, we protect against these large drawdowns. As you can see here and here, we are exited. So a more complex notebook we have available is to use decision trees on our RMI data. Now, decision trees are no longer linear; they are non-linear, and we can use this to extract the features we find out of our entire available features for this data. We can extract the most valuable ones. So here, what we've done is we've constructed a decision tree on our S&P 500 returns using our news and social feeds combined. And what we're going to do is take a look at which RMI or which features appear to be the most predictive or fit the closest to the data. In this case, we have the period of 2012 to 2019, and we've chosen 2012, 13, 15, 16, and 18 as our in-sample set. So, of course, if you were to actually do it in practice, I would, advise you to use something like an expanding window, or to isolate interesting periods together or group them together. So yeah, what we're doing here is retrieving data from Yahoo. I believe we can run this as well.
So Anthony, we just have 8 minutes left or so.
Okay, sure. Getting carried away here. Getting too excited with the data. So yeah, what we're actually doing here is just constructing a decision tree relating our indexes to the SPX returns. And we can see here that the most valued, the index with the best information ratio is bond sentiment with Guinea of 0.49. Here we are limiting our decision. Here we are limiting our decision trees to a depth of 3 because of course it's overfitting otherwise. And we can see here that when you construct a strategy out of this, it performs quite nicely. I'm pretty sure the S&P hasn't gone up 7 times in the last 8 years. So That's just one aspect. And then finally, this one filtered sentiment concept, which is where we isolate the reactionary and the novel sentiment components from the underlying raw sentiment. What we do is we simply construct a linear regression of various alternative feeds and our SPX, our SPY data. And in order to derive the filtered sentiment, we regress the SPX returns against the sentiment. And by doing so, the various returns against the sentiment, so that the sentiment can be decomposed into parts that belong, that are influenced by the returns, and parts which can't be explained. And essentially what we're looking at is the error term associated with the regression as our novel sentiment. So here you can see we have a nice R squared, we have our coefficients from our regression, and we have our correlation of the raw and filtered sentiments. This is the raw sentiment against the S&P's next day return, and the filtered sentiment against the S&P's next day return. And we can see quite nicely here that when you do isolate these interesting components, we have higher correlations, lower p-values. So I believe I will pass it back to you now, Richard, and you'll continue.
Great, thanks. So I will try to take control here.
I can make you a presenter. So,
Oh, thanks. If you can, please.
yeah,
Whoever does it first.
should have happened. I think you just need to agree.
Let's see. Hmm. Okay, can you see my screen?
Yes, it works.
Yes. Okay, great. So, great. Thanks, Anthony. So, just to give a quick summary, Anthony showed two types of strategies, or we've discussed two types of strategies so far with this type of data. And Anthony, I was answering questions while you were doing this, so maybe you can take over some of the question answering. Might be useful.
Sure.
So, and there were some great questions, and one of them, of course, was how predictive is the data? Do you filter with fake media? So I did answer the fake media question at 26 minutes after the hour, so you can look at that answer. I actually couldn't open the answer to copy it and paste it in the other two, but it's the same answer. Regarding whether it's predictive or not, I will give you some examples now. So I gave two use cases of this type of data already. One is that sentiment appears to predict trends. So if there's a lot of positive media about a company in 1 month, it seems to predict that over the next month it will outperform. The second use case is if they're at turning points. So as Anthony was showing with the Chinese yuan, with the crude oil, when sentiment, when the market has been doing well and sentiment turns negative, it often does so before the prices drop. We do see that quite consistently. And that was the crude oil example that we showed. That example was actually in our book, which was published in March 2016, but it was finalized in December 2015. And so since then, it's been running essentially out of sample and has looked quite good, including in the recent sell-off. So a third strategy that we see with this data set is this idea of buying on fear, or buying when others are panicking. And both of the two guys on the screen were, during their lifetimes, the wealthiest individuals in the world. So Munehisa Hanma was a famous rice trader and inventor of candlestick charting. And of course, we know who Warren Buffett is. Before we were selling data, we were actually a hedge fund. So we started the first social media-based quant hedge fund in 2008. We launched it on September 2nd, 2008. Now that week, that Friday, AIG failed. And then the next week, Lehman and Merrill Lynch, et cetera, everyone started failing within about, I think, 15, 16 days of when we launched. So unfortunate timing financially, but actually it was quite good for our strategy. One of our strategies was to buy on fear. And using decision trees, we had found that when there's this peak in fear around a given stock and the stock price has fallen but stops falling, so a couple of conditions in that tree, then it's a good time to buy because it'll likely rebound. So it has a capitulation, a panic, and then it rebounds. And using our fear data allowed us to identify which stocks these were. And of course, it doesn't happen all the time. It happens more during panics in markets, but it's quite a reliable pattern when there is this phenomenon. So we developed the strategy, and during the swine flu epidemic, we did this one trade, which is on the screen, and we actually used to show it to our investors. And so when this latest epidemic came around, we were referring back to this and developed some interesting predictive models based on that. So looking at various epidemics like SARS and Ebola, swine flu in the last 20 years with this data set, we identified that we could really see a good risk-off signal when the media about the respiratory illness started to spike up. And these yellow bars in this slide at the bottom of this top chart are the percentage of references to human infectious diseases in a given country. In this case, China first, and then the blue lines are within the EU. And so at the beginning, when they first start to spike up, more than expected is when the prices tend to start falling away from their benchmark. You can see it took Ryanair quite a while before its stock started to sell off. This dotted line here is the Europe 600 ETF. So I'm showing European stocks because we're speaking to a largely European audience. But this is true. Actually, we have examples from Korea, Japan, China, the US, elsewhere. What's interesting in this chart is there may be a buy signal when fear starts to fall. So you see fear peaked out around here and starts to fall. So we use two moving averages at the bottom here, fear in the Eurozone and then overall sentiment in the Eurozone. So we see when fear starts to fall, maybe that's a good time to buy. Maybe it's a good time to buy when sentiment starts to rise again and people's mood is improving essentially. We see both of these in this case. And both of them did precede the big jump in the markets. Not precede, it was after the big jump started. But certainly markets are up since the signal. It's a late signal, but it's kind of an interesting one. And we only have 4 epidemics to really model this on, but there does seem to be some potential interesting stories that, decision support tools we can build based on that. So the big picture again is there are different patterns in markets. There are periods of underreaction to information flow, which we see across thousands of stocks. For example, in the rainbow chart that Anthony showed, we see turning points and we see overreaction panics and rebounds in number 3. So based on these insights, we actually built a product to predict stock prices. This one we built with the StarMine team at Refinitiv. This was finalized last August. And since it was finalized, it has been doing quite well. So one of the questions was, do these actually work in forward testing, or are they just in sample results? So this model was created to take advantage of all 3 of those phenomena that I mentioned. And it also looks at contrasts, say, between news and social media. And it finds that when news and social media sentiment are compared, that sentiment from social media is actually more predictive. And sentiment from news gets a negative weight relative to social media sentiment, interestingly enough. So there's interesting insights that a more complex model can extract from this data. So using those insights, we built a model that is described here that shows when we rank stocks, not only do we have that, I think it was about a 3% spread between deciles, as Anthony showed in his rainbow chart, but we can actually increase that up to about 10%. And since it was launched in August, it has had more than a 10% annualized spread between, and especially in the last 3 months, it has had nice outperformance, probably, of course, because of the volatility and the fact that many stocks are being driven more and more by information flow. So here's how it was constructed. I know we're at the top of the hour, so please reach out if you have any questions about this model that we, again, built with the StarMine team on top of our much more complex data set. So bottom line, we have 2 data sets. We have the MarketPsych indices with Refinitiv, which is a very large data set of aggregated sentiment indexes for every asset. This model is a predictive model built on top of that for starting with US stocks, and then we are expanding it now globally as well. So built on US stocks, and that has also been predictive in forward testing. And it is also interestingly uncorrelated with traditional factors. So when we use a sentiment factor in our modeling, we find that it's not like value and momentum. It's not like earnings quality or analyst revisions. It's independent. And so this orthogonality of sentiment is also quite exciting. And Anthony has built some great hybrid models where we combine sentiment with other factors and we show how they're synergistic. Each one seems to amplify the effect of the other. So we do encourage you to reach out to us. And if you'd like a trial, feel free to reach out. We can get you in touch with a Refinitiv account manager to test these data sets. You can see my email at the bottom of the slide here, info@marketpsychdata.com. That'll reach Anthony and I and some of our other team members, and we'll be able to connect you with the right people to get a trial of this data set going. We also do have the Python notebooks that Anthony showed. those sandboxes. So you can explore and see the techniques that we've used. We also have a trove of 50 academic papers on this data set already, and we have many free book chapters from our book. So we'll try to get you set up with more resources to understand this new type of data. And if you think about alternative data these days, it's really all behavioral data. It's all credit card data, parking lot data. It's what are people doing? And amazingly, in my opinion, from the media, we can really see the seeds of influence that are coming through, the new information that people are talking about, and we can use that to better predict prices. So we hope you'll reach out to us and look into this data set. And really appreciate your time today too. So we will be continuing to answer questions on the chat box there. Thanks for your time.
Okay, thank you very much, Richard. I mean, Yves, I mean, do we have time to take a couple of questions, or do you want to kind of move on?
I think at least two. You can pick two maybe, and then should be good to go.
Okay, so we definitely had a lot of questions around basically the sentiment data available for every asset class. I think there were a number of answers on the forum that were basically saying it has a number of asset classes, including commodities, stocks, bonds. Is that right, guys?
Oh. Yes, so we have data for 36 commodities, 45 currencies, 170 cryptocurrencies, 62 stock indexes, 62 sovereign bonds, and 15,000 stocks. So yes, we have every major asset class, including even real estate, commercial and residential. So we're tracking that by country. So there's a lot of different, no matter what asset you're looking at, we can probably have data that's relevant to you.
Okay, and then we got another one from Bruno who asks, what's the lag between news publication and metrics update? Is the score calculated on event or every so often? And if so, how quickly does it adjust to the news flow?
Sure, so the longest articles we have take about 140 milliseconds to analyze in our NLP engine, but this is a 1 minute aggregate. So it doesn't matter that much. So it comes out every minute. And then some of our providers delay their content to us. So some of our premium news providers, not Refinitiv sends it within milliseconds, but some of our providers delay up to 3 minutes. So we'll have some minutely delays in our data from some providers.
Okay, and so do you augment your data with trends in the industry sector, e.g. FANG index? If a particular constituent is getting more sentiment against the index as a whole, do you take that into account as a factor?
We don't. So, for example, in the S&P, I don't know what
as a factor to reduce the score. Yeah.
Oh yeah. So we don't. Everything's equally weighted. So in our so for example, we have an S&P 500 proxy that we have, which is 500 stocks sentiment, but it's all equally weighted. Every score, any comment about Caterpillar tractor is weighed equally to Apple's comments. Now, it turns out that many technology companies have more comments, of course, in that kind of feed, but we didn't know of a way to easily balance it out to rationally create weightings. And so we do provide the data to you for each individual company if you want to create your own indexes and weight it yourselves.
Okay, that's great. So I think we've got many more questions. So if you guys could keep answering them on the Q&A forum, and I think we need to move on. So Yves is going to be talking about reinforcement learning.
Reinforcement learning, excellent. So, hello everybody. Also from my side, let me switch my slide deck here. Try to see reinforcement learning from playing games to trading stocks. I know that many of you out there are pretty excited, as I am, about reinforcement learning and what it can do with it. I have like a slide deck with some general overview after a quick introduction, also defining a couple of central notions and expressions that fly around in the space. And my main focal point will be on some code, which is from my current book in the making, which is called AI in Finance, and where I show that you can use the same DQL, deep Q learning agent, to A, learn a game, and to B, trade stocks. So everything will be kind of simplistic, just to make my point, but be assured when you will have a look at the book later on when it comes out, there are all the details, including how to backtest for risk measures like stop loss, how to include transaction costs, and all that realistic stuff. Also validation testing, which I skipped today. But I think the code itself already illustrates pretty well how to use Q learning for A, playing games, and B, trading stocks. So here, quick introduction. For those of you who don't know what we are all about, it's all about Python for finance and some other open source technologies. We provide services, we run trainings, we have a platform with some 25,000. 25.
Sorry, your screen is not coming through. Are you sure you're
Oh,
sure?
it's not there. Oh, I made it unintentionally. I'm sorry about that. I made somebody else with a different name presenter. This is not like what it was supposed to be. Sorry about that. Quick glitch. So.
Mon écran, j'ai dû le fermer.
I'm
Il a foutu avec mon écran, quoi.
sorry.
Il s'appelle Yves.
Yeah, so sorry. I need to. There was somebody with the same first name. I'm sorry about that. And I clicked simply on the wrong name there. So I was just like showing my introduction, my first slide here. So didn't go into the details there. In that sense, you didn't miss anything. So here we go. Anyways, I've shared already in the chat the link to A, my slide deck, B, the code that I'm going to use. So you should have access to all the resources that I'm going to use. So introduction, this is where I wanted to start. Here with some quick overview of what we do. Python for finance is the main topic. And we run trainings, services, events such as meetup events, usually in person around the world. Today, for the first time, virtual. We have certification programs. I've written a couple of books. I'll come to them later on. We've open source Python libraries for financial analytics in a broader sense, also for algo trading, a couple of things. As I said before, we run a platform for web-based analytics and Python code usage with some 25,000 users. So we also provide all our resources from the books, etc. So tpq.io will bring you to our webpage and more resources if you're interested in. Since 2.5 years, we're working on an algo trading platform. So for us, it's like walk the talk. I've been teaching algo trading, Python usage in this context for quite a while, and we started building our own platform. The major reasoning behind that is that it's pretty straightforward to come up with your algo in Python. Python is a pretty good language in that, but it's pretty difficult, on the other hand, to deploy your algo in a robust and reliable fashion. So maybe your algo code might have 150 lines of code, but your deployment code easily can run into the thousands of lines of code, and our platform is supposed to simplify this in a way that it should be a matter of minutes and not like days or weeks in order to deploy a strategy. The quick summary you find here of what we do, in particular in the training area. Feel free to follow up. It's a 2-minute read, should be quick. If you're interested, a little bit of more background here is the long version, too long to read here, but you have the access to it via the slide deck. So here are my current 2 major books, Python for Finance. If I'm known for something, probably for that book. No matter where I show up in the world, people come along and want to have a signature in that book. Pretty happy that it's already in the 2nd edition. So I updated it in 2018 because so many things have changed since the 1st edition, which came out in 2014. And I'm in particular happy that it's used around the world at universities to teach young students, even undergrad students, in Python for finance, that it has become such a popular topic. My next book, which will come out towards the end of the year, autumn or maybe winter, is Artificial Intelligence in Finance. That just finished like the code part of the book and everything, so it's ready for tech review. This will take a while, and what I'm going to present code-wise today is taken out of this book from the chapter about reinforcement learning. There's already another contract signed, and the book is finished actually in a draft, Python for algorithmic trading. This is more about the technical aspects and how to deploy, for example, algorithmic trading strategy by the use of Python. These are my quant finance books, not really related to what we do today, although deep learning, reinforcement learning now is also used more and more in quant finance, for example, regard to deep hedging and some other approaches, which when I was writing the book wasn't around at all, at least to my knowledge back then. Our certificate program, this is our, when you ask what we do business-wise, this is our main business, is the training program, online training program, where we run like 3 cohorts per year. It's a comprehensive program running over 16 weeks. I'm pretty sure we have a couple of delegates from the program today with us as well. It's basically today a few hundred hours of instruction, thousands of lines of code, and hundreds of pages of documentation. It's pretty comprehensive. We also have, and this is new, last year I added the class about AI in finance. This was starting point for my new book, and this year we had like a new class which is called reinforcement learning in finance. So this was the first time where I used the codes and the ideas that we are going through afterwards. So now you know what we do. Next, maybe a little bit of background. I'm pretty sure everybody knows the background, but I like to set the stage with the success stories, which I'm still intrigued and excited about. So one of my favorite ones is Atari games and reinforcement learning. This was basically the first time I became aware of reinforcement learning and what this is all about, because I have like a relationship. I'm old enough to have played the original console here. Today I have replicas, which you can buy for a few bucks on the web. But as a teenager, we were playing these games like crazy there, and this was Breakout actually. And here's the article which explains how deep reinforcement learning is used to play Atari games. And also in the class that I mentioned before, reinforcement learning in finance, I get started with some game-oriented introductory examples where we, for example, use reinforcement learning to master the Lunar Lander Atari game, which you can find in the OpenAI gym environment. So it's a little bit of I think it's the most playful class that we have in our program. And if you want to read a bit more about the background, this is like a pretty nice book which came out, I'm not pretty sure, maybe at the beginning of last year. And this is on a high level, it explains like the history of deep learning and deep reinforcement learning and how it's kind of like applied in areas such as self-driving cars, recommendation engines, playing the Atari games, example from before, image recognition, classification, speech recognition, and of course playing the game of Go. And this is one of the major examples that basically everybody is talking about still and is aware of, maybe became aware. And I was so intrigued when I was reading it a while ago. It wasn't 2014 when it came out, it was quite a bit later, where Nick Bostrom points out in his book Superintelligence, which I can still recommend today, that Go playing programs have been improving at the rate of about 1 dan per year. If this rate of improvement continues, they might beat the human world champion in about a decade. And we know it didn't take DeepMind, now a subsidiary of Google, that long, or Alphabet, I'd rather say. It was much faster. So 1 year later, 2015, they were able to beat the European champion. Everybody was like, yes, of course, he's European champion, but it's not comparable to the grandmasters from Asia, in particular from South Korea, right? But it took another year when the then current world champion, Ali Sedol, agreed for like the match. And AlphaGo won 4-1 against the current world champion. And one of the most renowned experts in the field was predicting a year earlier that it might take 10 years. And here we see like this jump in the strength of AlphaGo, as it was called back then. Then we moved on to other iterations. The latest one here in this context was AlphaGo 0, but now we have Alpha 0 without the Go attached to it. And you see how long it takes today to, or back then, here's from the web page, probably they have some updates there, to train based on reinforcement learning with a couple of other twists, of course, to train AlphaGo to be better than any human being on Earth, or to this end, any other machine down there. And what is also kind of interesting is that when they got started, they had like high power consumption. They needed 176 GPUs to become that good. And today, four TPUs are enough to play on superhuman levels. So it's pretty fast and it's still evolving. And of course, DeepMind have shifted the focus a little bit more to, let's say, more relevant disciplines like medicine, but still is fascinating. And what is even more fascinating, and if you're interested in the background, I've included here 2 links. The one is the Netflix documentation, which is, I don't know, 2 years old, 3 years old, which is a great watch, and also a recent podcast, the Lex Friedman Artificial Intelligence podcast. I'm a big fan of this podcast, and this is David Silver. He's like the main AI engineer behind AlphaZero. It's also pretty interesting to get like a review. It started for him with his PhD thesis. So just have a listen, have a look. Pretty interesting. And what I want to say is that AlphaZero for me is one of the most fantastic things, because we all know that human beings since quite a while don't have a chance anymore against chess engines, and you pick out your phone and you play any kind of chess engine that you find in the App Store. And yeah, you have an opponent that is stronger than the current world champion. So 3,000 ELO points plus is what they typically say. And here, if you're interested in the history, there's a book by Garry Kasparov, which came out 20 years after he was beaten by Deep Blue. I'm pretty sure everybody knows it. But AlphaZero, here, read it. This is for me kind of like the fantastic thing. The amount of training the network needs depends on the style and complexity of the game, taking approximately 9 hours for chess, 12 hours for shogi, it's Chinese chess, Asian chess, and 13 days for Go. So 9 hours of self-reinforcement learning, self-playing. And yeah, AlphaZero is better than all the other chess engines, and also, of course, than any other human player on planet Earth. So this is fantastic. And AlphaZero itself, and my code example will touch on this in a very, very simplistic setting. AlphaZero plays all these games. So it's just like a matter of like how you represent the rules of the games. Of course, the rules are different, the boards are different, the pieces are different, etc. So it's if you like, and some people agree here, that this has glimpses of real intelligence. And by real intelligence, I mean not like being able to work with large numbers and to do complex multiplications, which yeah, computers can do since a while, but here that you have one engine, whatever engine is. This is hardware plus software plus algorithms plus etc. pp plus data, of course, and it's able to master multiple games. And this will be in my example as well, where I use the exact same deep Q learning agent to master one of the games from the OpenAI gym and to learn to trade stocks or a financial instrument. I think I'm using another financial instrument to this end. So that's kind of like interesting that you have such a flexibility with these reinforcement learning approaches and that you can master many different areas. Fundamental notions, just to have a little bit of background. I'm pretty sure we have many, many experts on the topic today in the audience, but I thought it would make sense to have at least a couple of the most important notions up front. Of course, reinforcement learning itself. From Wikipedia, we can read here, reinforcement learning, RL, typical abbreviations, an area of machine learning concerned with how software agents ought to take actions in an environment in order to maximize some notion of cumulative reward. And this is pretty generic, right? Take action can be anything. An Atari game might be move the pedal to the left or move the pedal to the right, right? And of course, today, RL agents play much more complex games, but we will stick to the more simple ones, right? And the environments that we are going to see are also pretty simple. Reinforcement learning is one of the three basic machine learning paradigms alongside supervised learning and unsupervised learning. This provides us the framework, but let's go a little bit deeper. When we speak of an environment, these are my definitions. I haven't copied them, so this is my understanding and how I use these words and expressions and general notions. So environment defines the problem at hand. This can be a computer game, think of Atari, or some more complex stuff to be played, or a financial market to be traded in. Of course, we talk about market environments, right? And the trading bot should take appropriate action given a state of an environment, a market, or a game. And a state can be thought of as a vector containing all relevant parameters describing the environment at a certain point in time. In a computer game, this might be the whole screen with all its pixels, right? When you have a look at the older games from the 80s, this is a little bit more simplistic. If you have a look at a modern game, which might be played with 4K resolution, this might be a large data set describing the state. And it might even not be enough. So for the traditional card games, the older ones, the screen might contain all the information. But for modern games, there might so many things might be going on. Just think of Fortnite, which my son is a big fan. You have 100 players on an island, and you just see what is in front of you. But all the other players play the stuff as well, and they see different stuff compared to you. So here, of course, everything in a little bit of a simplified manner. In the financial market, this might include current and historical price levels, financial indicators, such as moving averages, macroeconomic variables, and so on. So this is here a little bit more art than science, I would say, and this is like the key part of any research effort in finance that you say, well, which parameters do I choose to come up with an agent that can behave appropriately? That we have the agent itself. What is the agent? Basically it's hardware plus software, right? So subsumes all elements of the algorithm that interacts with the environment, such that and learns from these interactions, right? So there is some action taken and there is a feedback given. Typically, this is called reward or punishment. The agent might represent a player, or in a financial context, we could think of it like a trader, a trading bot. This is what I typically use, placing bets on rising or falling markets, going long or short. An action, this is also, of course, dependent on the environment. There's an agent that, or it's what the agent can choose, right? One action from a limited set of allowed actions can be left, right in a simple game. In a more complex one, it might be up, down, left, right, and push the fire button, for example. In a financial market, this can also be pretty complex, but we resort to a simple long, short style environment where we say, well, he bets on a rising market or on a falling market. So just to simplify things there. Reward depends on the action agent chooses, and that a reward is received or a penalty is to be faced. And for a computer game, this is typically points, right? Points and total score at the end. In financial context might be profit loss or returns or overall cross performance, whatever you can define. So you have, of course, flexibility, and reward design beyond feature design is one of the key areas where you should focus on when you apply this to different contexts. Target specifies what the agent tries to maximize. In the computer game, it's the score, I guess, in general, or for financial trading bot, this might be a trading profit. Or think of a labyrinth, for example. If you have a RL agent who needs to find a way out of a labyrinth, this might simply be to get out there, right? This might then be the target to reach a certain point, whatever this then is. So we have now the luxury today that there is OpenAI Gym, where people who get started here with reinforcement learning have like a great variety of different environments that they can interact with. And the beauty here is a little bit that the AI, the API is consistent throughout all the games. So the behavior is consistent. And in my example, I will show you like a finance environment that I've developed myself. So implemented like with pure Python code, has nothing to do with OpenAI, but I'm going to mimic the OpenAI Gym standards in order to be able to apply the same DQL agent to the finance environment. Of course, you have all the freedom in the world to go a different route, but this is, of course, for illustration purposes. So OpenAI is a research laboratory in San Francisco, and they are basically after the big quest of humanity to come up with artificial general intelligence or super intelligence or superhuman intelligence, however you want to call it. So this is what they say, but they also do kind of like nice work for us Pythonistas, for example, and that they provide the gym environment as a toolkit for developing and comparing reinforcement learning algorithms. There are also challenges going on and rankings available on the web, and it supports teaching agents everything from walking to playing games like Pong or Pinball or many other things. So here, see like Space Invaders screenshot, one of my favorite games when I was young, and there are quite a few more in there. So what is Q learning now about? We have like the basic notions and definitions of reinforcement learning, but Q learning is a particular algorithm, and Q relates to the action policy. But the first formal notion that needs to be introduced is the reward function, and I said it already before. The design of the reward function is sometimes like the decisive factor in being successful or not. So basically, a reward function assigns to each state action pair. So you have a state given of the environment, and you take an action, and then a reward, in parentheses, or a punishment is what you get back given the state and the action. So what is now the action policy? Action policy Q assigns to each state S and allowed action A a numerical value. This is not necessarily now the reward from above, which is the immediate reward, as it's called. So here we have a second very important element. The numerical value is composed of the immediate reward, what we see here, basically, plus the discounted delayed reward. And this was kind of like the major breakthrough that people notice that, well, immediate reward might be nice in certain areas, but when I'm playing, for example, Atari games, I might behave differently when I take into account what happens in the future after I've taken that action, right? So this is all done based on Bellman equation and approach. And for those of you here in the finance meetup, we have done some American option pricing. The approach is pretty similar as you would like. Try to value an American option with early exercise, a Bermudan exercise, at least in a numerical setup. So we have the two components, and you see it here. We have a state and action pair. We get some real valued number, and there are two elements: is the immediate reward and the future reward, right? So we human beings, we know we don't really care about what happens to us like 1 month out. So we're only interested in general what is like the reward from the next action. That's the reason why we love cheesecake and all these nice things, right? We are not really thinking about the weight gain after 1 month of eating cheesecake, but here with this function, we take into account what happens in the future. And we are not just prioritizing what happens very next thing afterwards. The analogy in finance breaks a little bit down based on the approach that I take, because I will work with a static data set. For example, in our training, I simulate environments which are not as static as the example that I will show. But usually when you play a game, what you assume is that your action influences the path of the game, right? And with the financial example that I will have, this is not the case. So I just want to have my agent learn how to trade, how to predict the market right, but there is no like influencing the future return when I take a long or short position. This is kind of like a nice thing. Basically, I've written my PhD thesis about like feedback effects from trading when you hedge options and you go long and short to hedge an option, what impact this have on the market and which second order impact and feedback effect this might have on the option price. But this is not what I'm going to model here. So we take the financial data as static, but my game example will be dynamic. So what I do now influences the path of what happens next. Representation. Yeah, there are many, many areas where it's so difficult to write down the optimal action policy, let's say in a table form or whatever. Therefore, Q-learning in general relies on approximate representations of the optimal policy. And this is where neural networks come into play. For almost every approximation problem, neural networks might prove valuable and beneficial solutions. So due to the approximation capabilities of neural networks, like universal approximation theorems, there are quite a few of them. Neural networks are typically used to represent the optimal policies. Features are parameters that describe the state of the environment. Labels are values attached to each allowed action. So that's the basic idea. Now, three more important aspects. The one is exploration. So we want to have an agent that learns by exploring, and not only by exploiting what it might have learned just a few seconds ago. So my usual example, maybe not, it doesn't fit well in the current environment, but I'm usually like a global traveler, traveling like half a year usually. And I say when I'm new to a city, and then I probably use exploration to have a walk around and to see where the good restaurants are and what's going on there. When I have been to a city, let's say 50 times, I'm rather on the exploitation side because I have explored everything and I rely on my knowledge about the environment and the city. But still, when I get to a city like for the 51st time, I nevertheless will do a little bit of exploration, because maybe 3 months, 6 months ago when I was there, there's this nice little restaurant which just has opened, and I would miss in any case if I only would rely on exploitation. So this is like something that typically is modeled that we get started with exploration only, like 100% randomization, and the further we move on, the less we rely on randomization, exploration, the more we exploit what we have learned, right? You can find many, many examples for us human beings. You can say, well, the older you get, the less you are willing to explore stuff, the more you want to exploit your experiences, and so forth and so forth. And one other decisive element with reinforcement learning is that experiences and what has happened in the past, so to say, is memorized. The memory is built. So you collect your experiences, and then you do every once in a while. And with the algorithm, it is like it is a continuously ongoing element. You retrain the neural network in this context by replaying what has happened in the past and updating the optimal policy. So this is also, and when you think it through, all these ideas here of Q-learning as a specific algorithm of reinforcement learning, they relate pretty well to what we human beings do in life anyways, right? So that's what makes it for me even more exciting and attractive field to study. So we are already here on the demo side, and as I said before, the demo is taken from the book. The early release is out with 3 chapters. I was just preparing chapters 4 and 5 for the next release, but I've basically written as well 6, 7, 8, 9, 10, 11, 12, 13, 14 not, and 3 appendices are finished. So all the code parts are finished, available for tech review. This will start in May. So this chapter is not yet available, and beyond our online training delegates, you are among the first now to see this code. At least this is part of the chapter 9 about reinforcement learning. I have there much more realistic examples, and given the trading bot that I introduced there, I also have in other chapters where we cover backtesting and risk management, such as stop loss orders and trading stop loss orders and take profit orders. Also transaction costs are included. So a trading bot is really like tested in multiple directions to have it as realistic as possible in the context of such a book, right? But this is like the introductory example where I for the first time showed that a DQL agent, which can play a game, can also trade stocks in the market, right? And the game itself is from the OpenAI Gym environment, which you can easily install if you're a Python user via pip install. And you have a bunch of games that you can play. So here I used, I think it's now kind of tradition to introduce reinforcement learning based on card poll. With card poll, you have basically a card and an almost upright standing poll. And the problem is to balance the poll so that it survives 200 periods or steps, as they call it, by pushing the card to the left or to the right. So you just have 2 actions. This is the environment, and the environment will be described, we see it in the code base, will be described by 4 parameters. And the 4 parameters, for example, are the position of the card and the angle of the pole and the angle velocity of the pole, etc. So this describes the environment in simple terms, and the only actions that can be taken are push the card to the left or push the card to the right. But we can formalize this, and since we are all Pythonistas, or want to become at least Python Quants and Pythonistas, let me jump into my code here. So reinforcement learning from playing games to trading stocks. First things first, a couple of imports that I'm doing here, just standard stuff, and the OpenAI environment is easily imported. We have here Gym, and I choose card poll. The observation space here is a box object for elements. We see here the low values, which might be, depending on the algorithm that you use, it's not interesting for my algorithm, but might be interesting. You see here the high values. So you see this can range from fixed numbers or going to minus infinity for the low values to plus infinity for the high values. So this can all be looked up there. And when we reset the environment, what we get return is the initial state, of the environment. And you see here in the comment, the first is card position, the second is card velocity, then we have the pole angle and the pole angular velocity. Of course, this is kind of like a simplified physical model here. And when I reset the environment for a second time, there is an element of randomness. And this is something that we don't have in the finance example. But here, when I reset it, the numbers might change. They don't change by orders of magnitude, but there is some random element. So the card position is randomized. Everything is randomized here, right? So whenever I start, I get different initial state of the environment. The action space has two elements, so I only have two actions, and via the sample method, I can get some randomized actions. When I do this a few times, like here, let me repeat the exercise here. So 0, 0, 0, 1, 1, 1, 0, 0, 0, 1, 1, 1. So you see here that we get randomized action. This is helpful when you want to see how like a quote unquote dump agent behaves, and this is what I want to show. And before I go to the example, what you see here is an environment is stepped forward. This all happens here obviously asynchronously, so only when I take an action, the environment is stepped forward to the next state, right? And then what I get as a return is the new state, is the reward. This is 1 as long as I'm surviving. Done is false, and when done is true, then either I finished successfully or I'm bust. So the pole is falling down. And info, there might be some additional info here. There's nothing delivered. There's nothing relevant. So the game itself, this as a background, is successfully finished when you survive 200 steps. So they don't expect you to play like 20,000 steps, just like 200 steps. And therefore here I iterate 199 times, and when I finish that, I'm there. But probably I won't reach it because my first example here is simply a random agent, so no intelligence at all whatsoever, right? And when I play it, so this of course is now kind of fast, you see I survived 31 steps, and then I was finished. And when I play this again, here already after step 13, I'm finished. We see the state, we see the action. This is the random action taken, reward, 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 and then here done was set to true, and the game is finished early on. So if I reach 200, then this is considered to be a success. We can also nicely visualize that. All these environments, whenever possible, come with visualizers. So when I now use the same random agent, again, you see here sample, and I repeat the whole exercise, this time with visualization. What we see now, now you see it in action. So it plays, and now it failed. So I can repeat this here again. Let me execute it. It starts in a randomized beginning, and now it failed again. So whenever it reaches a certain angle, this can be seen here visually, the game is finished. So here my random agent is not really successful. This agent fails after, we have seen, maybe 13, maybe 31, or whatever the number is, right? Only if it would reach 200, then this would be considered a success. Now we come to the hopefully a little bit more intelligent agent, the deep Q-learning agent. And I use, as outlined before, a neural network, a simple, dense, deep neural network. Nothing special. I'm inputting dropout, but I don't think that I'm using it here. Sequential model, Adam is the optimizer. This is kind of like standard stuff. I set the seeds. This takes a bit. The import of TensorFlow with keras and everything takes a bit. I have here a function to set all the seeds, the Python seed, the NumPy seed, the TensorFlow seed, and the environment seed for OpenAI Gym. So this, my example is inspired, and I first came across here in this blog post, so feel free to explore this blog post as well. Explains certain details that I might skip over or have a look later at the book, but this might take a little longer until you get access to the book. So now to the code. I don't want to go into every detail, but I want to highlight certain elements here. So epsilon is the factor which says, or which specifies the ratio between exploration and exploitation. When epsilon is 1, we do 100% exploration. So we just use like randomized actions. And the minimum for epsilon is set here to just 1%. So towards the very end, maybe, depending on the number of training steps that we have, we will have still 1% exploration. Epsilon decay, this defines how fast epsilon goes down from 100% to 1%. Batch size is for the replay. The learning rate can be defined by default at 0.001. So here memory, this is where the experiences are stored, and the maximum T reward, this is also stored to track it. So the model here is to have the neural network which approximate the Q optimal policy in this context. So it's pretty simple. See here 24 hidden units, 2 dense layers. So I have 2 layers here so that we have at least a deep neural network, and I can call it deep QL agent. Here is the ACT method, and you see whenever a random number between 0 and 1 is below epsilon, then we take a random action. Otherwise, we rely on our neural network. So pretty simple, straightforward, either random action or we use exploitation based on our neural network that is trained over and over. And the most training here happens during the replay, where we, from the memory, take a batch size, like 32 experiences in this case. And here's now the Q learning formula, where we have the immediate reward and we add the delayed reward to have the future taken into account here as well, and not just having a look what happens immediately afterwards, but after this and after this and after this. This all relies on the Bellman equation and leads to optimality in the limiting case when we have enough trainings. Here we see that the epsilon decay is brought into place where epsilon decreases. This is the main method, the learn method. You see it's not too long. We iterate over a number of episodes. We reset the environment here every time. This is a technically required reshaping. We take an action, we move the environment 1 step forward, we have the next state, we append our experience here to the memory, and so we go step by step here through all this. And when we get done true back, then we calculate the total reward. I also track here the average total reward to have like a performance measure, and we do some printout. Here we finish, for example, the game or the agent is considered to be successful when it averages a score of 195 steps or higher. So, and here we start the replay whenever we have enough memory. The test function here is just like a little helper function, which allows us to test the performance of the agent afterwards. So when training is finished, we then can rerun, let's say, 100 test runs. And this is when you have a look at the web page, this is how it is defined. An agent is considered to be successful for the card pool game when it averages a score of 195 or higher over 100 consecutive games. So I can then run here 100 games, 100 episodes, as it's called here, and I can then come up with an average. So that's the whole DQL agent, DQL standing for Deep Q Learning Agent. Q Learning, we have, at least in rough terms, discussed how the algorithm works. The D stands for deep. Deep meaning here our neural network, which approximates the optimal policy, is a deep neural network. And here it's not too deep, but at least we have 2 hidden layers with some 24 hidden units. So that's the DQL agent. I instantiate now my agent object. First I set the seeds to have at least some reproducibility. Since I'm using the Atom optimizer, it's not fully reproducible because we have randomness in the optimizer as well, but I expect some good examples there. So episodes 1000, we have an early finish. So when we get an average of 195 or higher, let me see whether I have, no, it's higher, it must be higher than 195, then it finishes the training. So when it's good enough, quote unquote, after 500 episodes, it will stop early. So we don't need to wait here. So I let it run. This should be an example which is rather quickly finished. You see the average increasing here in the beginning. It's pretty slow. And then we should expect some better numbers. We saw some 100. Oh, it's kind of disappointing me. What's going on here? But now it's increasing. You see, once it gets the trick, so to say, it's like when you play a game and you learn a game. It's now I understood, right? It would be the first time that I don't get a good enough agent. Well, maybe we see it before 1,000. Sometimes it finishes. Now we got it. 732 episodes, and the average is now 197.9 over the previous 25 repetitions, and this means that it stops. And let us see what epsilon just I usually want to look it up. So at this point, after these many iterations, exploration was only done for 2.5% of the episodes. Here you see how the performance measured as the moving average of 25 consecutive episodes increases. So I like to have here like a cubic regression to get a feel, because since we have lots of exploration, you see here that there's a high variance in the performance measure that I'm using here. And at the end, you see there's a steep decline, and here it was stopped out because it reached a level of 195. So now we have the 100 tests and see whether this is a successful agent. Recall 100 consecutive runs, and the average should be 195 or higher. This is how it is defined. So the agent that we have seems to be pretty good. I've seen many perfect ones, but not everything is perfect. You see it here. And the average is, we just cracked the 195 benchmark, so we have 196. So this would be considered a successful agent in this context. DQL agent applied to our little card pool game. Of course, there are many games going on behind the scenes. We don't have visualization here. We don't need it, basically, or the agent doesn't need it. It's a highly abstract environment that the agent deals with now. So coming to the finance environment, but let me execute this and then get back to the code and explaining it, because this might take quite a bit. So I'm starting here. This might take quite a while until it finishes. And here in the finance environment, I introduce first two helper classes, which allow me to mimic the behavior of the OpenAI Gym environment. And this is with regard to the observation space and the action space. You see, these are like almost empty classes just to have like the API mimicked. This is now my simple finance class. In the book, there will be quite a bit more sophisticated one. I rely here on a static data set, which has end of day data coming from Icon or Workspace, the Refinitiv Icon data API, end of day data. And we have a couple of rigs in there. And I think the example is based on euro US dollar exchange rate. So we have symbol features, observation features here is pretty limited. In a very simple example, it's pretty limited. Observation space should be as it is. Here you see the instantiation, action space. And the whole environment works now as follows. We have defined here a minimum accuracy, which is set to 50%. So I said, well, after a certain number of first steps, the minimum accuracy must be 50%. Otherwise, we wouldn't have like a really intelligent agent, because 50% is like the baseline prediction. In particular here for a mean reverting quantity, such as the euro US dollar exchange rate. But more on that in a few seconds. Here we get the data, the simply helper method. I get the data from the remote URL. Here I prepare the data, and basically I only have returns data or the symbol itself, the price, the exchange rate here, which I can use as features, and I have here the direction, which is to be learned there, right? So if the market goes up or down. Here, another helper method, which gives me the state values. Seed is just here pass. Just to have the API in line, and reset means total reward is 0, the accuracy in the beginning is 0, Here bar is set to OSN, and OSN comes from above here. OSN is the observation space, the shape of the observation space, initial state, and I return the state values. And a step is now taken as follows. I put in an action, either 0 or 1, up or down, long or short, however you want to call it in this context. And the action is here correct when the action is the same as the market direction, right? So when I say market goes up and I see an upgoing market, then I would say it is correct, right? If I say the market goes down and the direction is up, then of course it wouldn't be correct. Therefore, the reward is here given with 1 if it is correct, and otherwise 0. So I try to really mimic almost exactly what is happening with the card pool environment, and the total reward is increased by the reward, so either 1 or 0. Bar is moved forward, the accuracy is calculated, and here I say, well, whenever I reach the end of my data set, then I'm done, I'm finished. If the reward is 1, I'm not done, so I can play, quote unquote, further, I can trade more. And here I say after some grace period of 10 trades, I expect the trading bot to have a minimum accuracy of 50% or above. So when, let's say after 20 trades, it falls to an accuracy of 45% or whatnot, I'm making up numbers here, then it would be finished out early, otherwise false. So pretty simplistic environment based on some fixed data set. But let us see how it works in action. So here we have finance. I said euro, yes, dollar is what I want to pick from data set, and my features data is the log returns data set for that. So I take the log returns here. When I do an end reset, we see here exactly like with the card pool game, we have 4 parameters, but these now are the 4 normalized lag parameters. So I skipped over that. So here I do data normalization. So when you wonder what these log returns are, I do. This is also just like on in-sample data set, there is no differentiation in training data, validation test data. This is just a simple in-sample example. So these are log returns data that is normalized. So I have my sample method, which gives me a randomized action, long or short. And when I step forward, you see this looks exactly now as it looked in the card pool environment. So we are good to go. We don't have any other agent. We only have the Q agent. And you see here, I instantiate the Q agent, learning rate. What I do is, since my actions do not influence the future course of the euro-US dollar exchange rate, there is no feedback effect whatsoever in my model here. I reduce gamma to 0.5. So I reduce the importance, the weight of the future reward of the delayed reward significantly. But still, anyways, we want to have like an agent which is not only good, quote unquote, with the next day's prediction, we still want the agent to learn like, to survive the whole thing, right? So we want, if we have a data set, and a data set is of length 2,511 data points, we want the agent to, the trading bot, if you want to call it that way, we want to trade it until the very end. We want it to survive, and maybe now there's like the stopping, the finishing number is set to 2,400. I hope that we see it. Otherwise, if it takes too long, I have a static version. How it's like going down. It already survives here on average 1,600 something. So this is a good one. You see, whenever you see here the maximum 2,511, this is where the trading bot survives from the beginning to the end. But again, have in mind, it always starts at the same starting point, starting value, and it always ends at the same ending. There is no randomization whatsoever in there, right? So maybe in order to not need to wait a few minutes longer because there's some randomness I cannot really predict, I have prepared a fixed one here. So here's the HTML version. It's the same agent, 1,000 episodes. Here it stopped after 830 episodes. The average was 2,427, so that's above obviously 2,400. The maximum, again, what we saw before is 2,511. This would be considered a complete success. It trades from the beginning until the very end. Epsilon after 830 is just like 1.5% exploration. And here, just 3 tests. I mean, again, here for the testing, if it gets it correct once, it will get it 1,000,000 times correct because we don't have any randomization. And you see the moving average here of the trading bot and the increase in performance, so to say, until here it reaches the point where it is above 2,400, 830 episodes were played. And the agent has learned here in sample with all kind of like the simplifications that we have discussed to trade the stock and to predict correctly, given our thresholds that we have defined, the stock market. And in the book, for example, I then go much, much deeper and do a vectorized backtesting of the performance of the trading bot. We include transaction costs because the number of trades that the trading bot does, of course, plays a role with regard to transaction costs. We then backtest also, as I said, risk measures such as stop loss, trading stop loss, and take profits. And there's also an example where I then show how to deploy such a trading bot in real time, where you need to process data in real time, like tick data that is coming in, where you resample the tick data, and then the trading bot digests the data in real time and spits out positions, signals first, positions second, then as a consequence, and gets into the trading, into the live trading, because this is just the first step. Of course, there comes the point, and this is our story of the AI machine, where you want to deploy your reinforcement learning agent also for trading. And with the AI machine, for example, we can deploy also easily such reinforcement. We can train them, test them, and also deploy them easily in a matter of seconds, actually, when you have the code available into production. But in the book, you get at least more sophisticated, or let's say realistic examples where reinforcement learning is used to build trading bots that then can be deployed in practice. You see my code here is still running, so oh no, you shouldn't go here for like, what's that? Some update. You see, even after 860 iterations before it was finished already, here it takes obviously a little bit longer. Currently it looks pretty good, so maybe we now got it after 9 minutes. That's actually pretty long. My test run before was some 7 minutes. And you see that the learning curve, quote unquote, here is quite different to what we saw before. There's quite a bit of randomness still over here. And you see it took it quite a while, getting better, worse, and here it finally got through it. So simple example. The one analogy that I wanted to highlight here is the one of AlphaZero. AlphaZero is able to learn not only chess, but also shogi, which is more complex, and Go, which is even much more complex than the other two. And here we have a DQL agent, which in principle, is able to not only play a game such as card pull, but with the environment, which was purposely designed to mimic exactly the environment of card pull, to also trade stocks, to predict markets, and to be able to be used actually also as an algorithm with a little bit more work afterwards. Yeah, this brings me to the end of my presentation. I don't know, Jason, if you have selected one or two questions.
Fantastic. Thanks so much. Yeah, so we had quite a few questions come in. So Rex is asking, in which areas of finance do you think reinforcement learning is useful, and which areas is it not useful for?
Yeah, that's a very good question. I'm a person who has the luxury to focus on whatever I want to focus on. So I'm mostly interested in trading, and I think in trading that's a pretty exciting and good area. I know, I've seen, and this is where I'm originally coming from, it's the quantitative finance, financial engineering, or computational finance area, where you can use reinforcement learning, for example, to learn hedge strategies, which might even outperform. Some people have published papers in this regard. Other available strategies, in particular when you don't have any quote-unquote closed form solutions such as from Black-Scholes Merton, but also I think there are unlimited areas when it can apply it. I'm not sure about like the successes, but what I wanted to highlight here as well is that stuff that is applied to playing games might be immediately applicable to financial problems as well. So there's usually not that much of a how should I say, transition or migration effort that needs to be done. You just need to get the input right, and then you are up and running. So I'm pretty sure, to close that question or answer to the question, that we will see many success stories in this regard in our field as well in the future.
Jed is asking, which reinforcement learning algorithm is best suited to stock trading? PPO, SAC, others?
Again, I'm like focusing on certain aspects, since I'm not a researcher and I'm not required in that sense to compare things and do large research studies. In this regard, I cannot really comment on that. So what I'm showing here, we applied these methods, which have proven pretty useful in a more sophisticated way than I was showing today, with many different features and different implementations there. But I'm not too personally, this is a really personal answer now, too much concerned in comparing that stuff later with other alternatives there. But of course, it's a very interesting topic, and maybe I could imagine that there are research papers out there and researchers that are interested in this particular question.
Okay, then we have Arpatel is asking, in RL reinforcement learning, how do you handle exploitation to maximize reward and avoid local optima? What parameter changes do you take into account to do this? Usually it's a random change. Would you do the same in a trading environment?
I don't know exactly what this relates to, but if my rough idea is correct, I would say yes. You would need to have some random element in order to not fall into local optimum in the sense of like relying on exploitation, which is allegedly optimal, but which, given maybe new experience, for example, if you have an online algorithm which learns continuously, which would benefit from further exploration. I mean, you can control it in my simple example by setting the epsilon minimum value, where you say, well, maybe the environment is so unstable that I keep the exploration at a 10% level, right? So for the training continuously, this is one simple thing in my setup where you can control for that.
Okay, so Dario is asking, the trading bot demonstrated seems like a case of overfitting to available data. What changes would have to be made when deploying a bot to a real-time feed?
Yeah, of course. And this is what I was saying. This is in simple, and I simply let it run until it masters it, right? When you think in terms of a game, like an agent required to escape from a labyrinth, for example, once it has mastered the one labyrinth, right, then it will master it the second time. So there is for sure overfitting going on. But as in other disciplines, you can introduce validation data sets, you can do sequential learning, you can also do online training. But the online training approach, when you do it in real time, of course, has the drawback that it takes ages until you have enough data, right? In that sense that we here do 1,000 iterations in a matter of minutes, but for the same stuff to happen like in real time, this might take months, right? The other thing that we do that I also teach in our classes, that we use Monte Carlo simulation to have, for example, different regimes, let's say a trend following regime, or like trending prices, so to say, mean reversion, and you can simulate different environments, and then you have like the luxury, so to say, that you have maybe 100,000 mean reverting time series of which you can train your agent on, right? Instead of having just one time series here, end of day data for the last 10 years for euro US dollar exchange rate. This is simply as it is. But anyways, you can work differently with that data set to avoid overfitting many different aspects. Also going down to the technical level, where you have all the regularization techniques like dropout or regularizers on the neural network level, etc. pp. Like, yeah, but I see the point that this is, with the example that I've shown, for sure, that's absolutely overfitting thing there. I let it train until it masters the whole thing.
Sure. And then Bruno is asking, doesn't reinforcement learning put an accent on memorizing past winning actions as opposed to finding causal relations between environment variables?
Yeah, I mean, the basic idea here is, and you can buy into that or not. This is what I tried to point out when I said in finance, it's here one of the major ingredients is how you model the finance environment in the first place, right? So I just go here first with time series related data. Second, I'm only concerned with like lag data, 4 days going backwards, 4 lags, returns data. And if you believe, I don't say you should, but if you believe in stories like technical trading and patterns-based trading, and that machines are pretty good at spotting patterns in the market, there might be some causal relationship that the neural network indeed can learn here. So agreed, past successes, but if you somehow believe in the persistence of patterns in markets, what many people do out there, this is one approach that would fit into this philosophy. But this is, of course, it's only one way of modeling the environment. I could include here new sentiment, what we have heard before. I could include fundamental data for whatever I'm trading. So I'm not limited to what I'm using here. One example in the book includes, for example, more other technical indicators like simple moving averages, volatility factors, momentum elements. So you can basically put into the mix whatever you think personally is appropriate, and then see how the agent learns and behaves afterwards and performs out of sample.
Yeah, so it would be feature neutral, basically, the broad technique.
Yeah. This is you see my major approach here was to mimic the card pool environment with a data set where everybody can replicate what I'm doing.
Great. Carlos is asking, can you provide the software stack that you used? I suppose some of that will be available in the notebook that is already available actually in the chat, and you'll be receiving in the
there's not much of a software stack, so I use only standard stuff. So it's NumPy pandas. Here I'm showing the imports. NumPy pandas is what I'm using, and then it's TensorFlow in the backend and Keras as the front end wrapper. That's a little bit of scikit-learn, but I think for this example I didn't even use the accuracy score. So this is what I'm using. There is not that much of a stack behind what I'm doing there. If you go further, want to then deploy your stuff in real time on a Proco platform, etc., then you need a little bit more technology. But it's also more or less a matter of 1 or 2, 3 pip installs, not more. Everybody can do it from their laptop. There's nothing special there.
Okay, thank you, Justin. Justin says this is absolutely amazing. Carlos is asking, any papers and books for reference to read? Obviously, your forthcoming artificial intelligence and finance book would be the go-to reference for that. But any other papers, seminal stuff you recommend?
Yeah, there's the book by Marcos, which is called Financial Machine Learning, which is a high-level research-oriented treatment. There are a couple of other books that trade machine learning or cover machine learning for trading and finance, but I think the approach that I'm using is not covered, at least to my knowledge. Maybe somebody knows and can point me to some resources, but not directly related. Of course, you can get started reading the book, for example, on learning.safari. Sorry, this used to be Safari on learning.o'reilly.com. For example, 2 more chapters to follow, I think next week maybe. But unfortunately, in particular, this chapter is not yet reviewed and not yet for publication. But just Google it, see our stuff, and some other people have published stuff in this regard as well. Yeah.
We have a request from Remy, maybe if it's not already there. He's asking, in your forthcoming book, do you talk about limit order book with reinforcement learning?
No, because my major approach, coming from a training background and also when I write a book, is that I try to provide reproducible codes, research, and results, right? So this is not always possible to the numbers, to the 5th digit, let's say. So I rely mostly on just time series related data, because everybody can download the data set and can follow this up. So this is not like on that level, so to say. So it's still like a, let's say, more a Python book than like the highly sophisticated expert going too deep book, because not that many people have access to limit order data.
Yeah. I mean, in terms of, I mean, obviously Remy knows that obviously it is a lot larger in terms of the the number of the size of the data streaming through and stuff like that, and the history even is extremely large.
Extremely large, yeah.
Extremely large, and then you need the scaling to deal with that and stuff like that. So, but if you're interested in that, Remy, just drop us a line. I can maybe get somebody from our labs to take you through. We have a data science accelerator which you can play around with limit order book data. We already have the Python notebooks already there. Stephanie is, I think, maybe making a comment. Best way to replicate is to use inverse reinforcement learning.
To replicate what? So I don't know what.
Maybe Stephanie, if you clarify that. Sorry, I know I missed you in the previous talk. She put many comments and I forgot about that. Boris is asking, does this use TensorFlow version 1 or 2?
2. All updated for 2. I mean, primarily I'm using throughout the book Keras. So I'm using Keras and it's TensorFlow 2.1 or what is the current version in the backend.
Okay, and Stephanie has also actually answered very kindly some of the other questions about the papers and references, maybe Igor Halperin's research work, Ritter and Combe research work. So thank you very much, Stefan. I think that's broadly replicate the market, Stefan. I think we're running out of time here. I think we're a bit over our allotted slot. We've been here for over 2 hours. So essentially, before we go, we're very basically lucky to basically offer you a book, some book raffles. So basically, if you see in the chat panel or in the follow-up email that's going to come tomorrow after this event, basically we're offering a 3-month trial of the Icon terminal, which includes access to the Icon data API, where Yves has got some of the data from, and also the apps that you saw earlier from Richard and Anthony. So you can sign up at the link there, and you can get a free month's trial for Icon. It may be nice for you to have a look at that in this kind of current market environment, to have really up-to-date stuff and use some really nice, cool APIs. So the first 5 or 10 people, I don't know, let's see, who kind of sign up for that will get a free book, one of Yves' books. He has 3 to choose from for very shortly. So we'll just do that. So anybody who wants to do that, it's in the chat panel now or in the in the email tomorrow. Anything else, Yves? Any closing comments? We have so this is the first one in a series now of our virtual meetup events, because we have this capability. It's been really interesting from our point of view to see so many of you from around the world. So we're having our next one on the 14th of May, and we'll be putting the event information on the various meetup groups that you already subscribe to. We can, Yves, any
yeah, I mean, it's also worth pointing out that if you find a few minutes, then we would be grateful if you can fill out the survey when you log out from GoToWebinar. This helps us a little bit shaping future events and selecting topics, and also with regard to frequency and format of the event. So it would help us, like, making it more relevant for all of you out there.
Yeah. A second. Yeah. So when you oh, where's that gone? Sorry. So yeah, when we end this webinar, there'll be a survey. Sorry, my computer's messing around a bit. I don't think they can see a chat box here, so I'm going to post the link.
No, this will happen automatically, so they get prompted to fill out the survey.
Yeah.
Yeah.
Okay.
But this should GoToWebinar should take care of that, fortunately. Yeah, I think from my point of view, that's it, basically. Jason, do you have anything else?
Okay, I've just posted that in the chat window. There's a chat window in your panel. You can do that. Otherwise, you'll receive an email tomorrow, which will have that. I don't know, maybe we'll do it randomly a bit. The first people to sign up, or maybe 5 of the first people and 5 randomly. That'll give you some incentive to go.
That sounds
sign
good.
up.
10 people. Right.
So, and that's it. So thank you so much for everybody. I'll stay on and answer a few of these other questions, but thank you so much for your time. We really appreciate it. We've been going for now 2 hours and 15 minutes. We hope you found it really of value. Yves, I'll leave it to you just to close.
Yeah, it was great pleasure and real excitement for me to bring all the meetup groups from around the world together. And yeah, as Jason said, hopefully we see you in the next event, 14th of May. And until then, stay safe, take care, and see you there.
Okay, everybody, I'll stay on and answer some questions, and feel free to log off. So,
excellent. Bye-bye.